Do evil market makers manipulate markets so that your precious calls and puts expire worthless? Let's investigate. Welcome, fellow investors, speculators, and traders. Today we want to have a look at the max pain trade. What is the max pain trade? And does it, in how it has always been described on very many wrong YouTube videos, really has some conspiracy behind it, how market makers and dealers manipulate the market? And is it actually correct? So let's start. The max pain trade versus max Malarkey. You already see I'm a little bit biased. Yeah. First of all, I used to be a market maker. That was my profession. And I lived in England. That's why I used the word Malarkey. I was trying to use a different word, but as I want to stay on YouTube, I've asked Grok to give me a better example. And Grok came up with Malarkey. So let's investigate the influence of option markets on cash markets at expiration. Who am I? Thorsten Roland Wegener. I used to be a market maker. I started working in the financial industry at some of the biggest banks in the world in 1995. And I was a market maker. I eventually became chief trader. Then I was head of trading. I moved to London and I retired as a partner in the derivatives business for Bear Stearns. And since then, I am an investor and a chef and a cleaner and an Uber driver for my children, and apparently, besides writing the odd article, I'm a YouTuber. So stay with me and allow me one more plug for my German viewers. There will be a new seminar at the end of September. I link I put the link in the description. That's the right word. And if you're interested, please have a look at it. So, the max pain trade, what is this? There is a hypothesis out there, and let's investigate that. First of all, market makers are in the business of selling options. That is correct. I can sign off to that, but there is something missing. You already know it. We're not just in the business of selling options, we're also in the business of buying options. And we're also in the business of not just buying outright options, but buying options back. That becomes important later. And evil market makers and dealers, what are they going to do? It is in their interest to let the majority of all calls and puts expire worthless. That means, in our terms, out of the money without any intrinsic value, at exercise value 0. So you spend money on a call, on a put, and the market doesn't do what you expect it to do. And when this option expires, it's worthless. And that's what we want to achieve as market makers. As you all have heard the statistics, 80% of all options expire worthless. Yeah, that is true. And this is because the market is steered to a price level at which most options expire worthless. Steered by whom? Obviously by the evil market makers who manipulate the price to expire at this price level, which causes the greatest pain, the max pain for the customer. And this max pain point can be identified and used profitably in your own trading. Yeah, of course, when you know where the market is going to expire, excellent. That's why I want to be long or short or whatever the market allows me to do to make maximum profit. So it should be fairly easy, right? Let's have a look into it. We can actually analyze that and see whether it makes sense. We determine the open interest in the next expiration cycle because that is what attracts us at the moment. Oh, expiry is 2 weeks around the corner, and I have to have an idea where the market will expire. If the market makers really do have this power to push markets in one direction, and if I know that in advance, I can make money. What do? I list contracts by strike price, everything that's out there. Then I determine the intrinsic value at each price from all these options that are out there. In this example, I'm going to use with a spider between 400 and 600 points. And I multiply then the intrinsic value determined in this way, when this stuff expires, is it in the money, is it out of the money, by the number of open contracts. What have I achieved then? I know the volume that is out there when I say, okay, so much money can be earned or not earned when I multiply the number of open interest with the likelihood that they are making money, even though it's not likelihood in this case. It's just a number which tells me, is it in the money, out of the money? If it's in the money, how much money is that? Then I sum them all up, and I'll show you an example in a minute. It's not complicated. So we add it all up, and we get the exercise value for each contract. So, and the market makers obviously want to have this minimum exercise value of all the option contracts out there, because they want that you, the customer who is buying option, forfeit your premium. So it's very easy. Everybody of you can do that at home with a simple Excel sheet. I haven't chosen an example that was the spider with expiration on the 15th of March 2024, and I think we were 2 weeks in advance when I plugged all the data out of public available sources. They don't have to spend too money for it. What do we see here on this chart? We see here the strike levels, and then we see the open interest. How many of these options are there in the market? Open interest means they're not closed. Yeah? It's not the volume that's been traded. It is open positions out there in the market. So if we have a market, for example, at 499, these would be the call options with a strike 499, and these would be the call options with a strike 560 and 622, or here at 379, deep in the money. Obviously, I can do the same for all the put options out there. I look at the open interest, contracts that are not closed, look at the strike. Here in this example, let's say 410, we see there are a lot of options out there. Yeah? And we go a little bit deeper, there are more options out there which are still open. So somebody bought them to protect themselves, and somebody sold them and got a premium for that. So what am I going to do now? Obviously, I take both together because I'm interested in a picture for the whole market I have in front of me. And then I say the value of all call options at a certain market level. So how can we understand that? At the moment, let's say the market is at 496, yeah? Which means a 410 call already has an intrinsic value. Yeah? You can exercise it, buy the market at 410 while the market is trading at this level. And I can do that for each contract, for each strike I have. Yeah? Let's say here 379, there are a couple of contracts out there. If the market expires at the level here at 469, then that would be the intrinsic value. Yeah? The 379, if the market expires at 380 in this case, that would be the intrinsic value. If the market expires at 410, that would be the intrinsic value we have for these options. And I add them all up, and then I get, oh, that's the next step first. And we can do the same for the put options. I repeat the example. Yeah? Let's say we have, well, I'm going forward. Let's say we have a 469 put here, yeah? And at 379, that would be the intrinsic value. Yeah? That would be the intrinsic value for all options which are above here, not just for the one, but for all options which are deep in the money. Yeah? If the market expires at 348, then the green line is added up, the whole intrinsic value of what we have available there. So we've done the same for the calls, and then we obviously want to see what's the maximum intrinsic value at which strike prices. For the calls and the puts, we already know, well, the calls here will be worthless if the market expires at these levels, and the puts will be worthless if the market expires at these levels. That's why we have the green and the red lines in there. Now let's just remove the open interest, and we have pretty good overview about when the market expires at 287, for example. How is the intrinsic value of all these puts and calls I have in here represented here? And if the market expires at 622, then we have the intrinsic value of all options I have. Puts, calls, all strikes over here. So you can already see there is a minimum here. Yeah? And this minimum is the so-called max pain trade, because option market makers or dealers are just selling options. And if I sell options, I have to pay out if there's an intrinsic value for these options at expiration. So as the tail goes, I'm interested and push the market to this point where I have to have the least payout when the market expires, as we can see here. In this example, the spider was trading at 513 2 weeks prior, and we have 470 as the strike price where most puts and most calls will expire worthless. And as market makers and dealers are pushing the market down, that is where we could end at expiration. All right. One of the points that's never mentioned in these videos is how actually market makers work, and that's why I'm bringing the gamma positioning in. All of these options we are buying and selling, they have a gamma. If you own an option, you're gamma long, which is beneficial, and if you're gamma short, it's very, very bad for your positions if you're not hedged appropriately. Even if you're hedged, it will still give you a bit of a headache. So do we have a fire and forget situation where I just say, oh fine, I've just calculated the max paint rate, that's where the market will be because the market makers are going to push it there under the assumption that they want to have most of these options expire worthless? Or is there something going on in a market maker book, and that's the dynamic hedging we have in here. So the gamma distribution, just briefly, here you could see the gamma distribution for all the option strikes I have out here, which says when we are at the moment at, let's say, 499, these are the call options. This is long call options. They have a positive gamma. And then there are less strikes out here and less volume out there, so my gamma is getting smaller. And these are the put options. I have them now on the negative side, and we'll explain in a minute why this is on the negative side. Let's assume you are long the 530 put, and mark, then the gamma would be here where the green is. Let's go a little bit into the money. Out of the money at 469, you would see, okay, if the market goes to 469, there's a lot of gamma suddenly. It increased dramatically on this road. However, this is a minus in there. So the customer is long a put, right? Then he has a negative delta. And if he has a negative delta, he has a positive gamma in this case, because he bought an option. If you buy an option, you pay a time premium for it, and therefore you get the good gamma. However, this is the perspective that is interesting, because this is the book of a market maker. I've just netted up all the gammas. You can do that actually. You can say, okay, these are the long calls I have here, where we've calculated the gamma, where we have positive gamma. Green is the puts. Let's start with the puts without long or short by now. Obviously they are short. That's why I have a short gamma here, and I can simply add them up at the strike price, and I end up with the green, with the gray field here, which gives me the net gammas I have here. So that was our calculation. We have a max pain at 470 and the market is at 513. Can you really see here something? There's positive gamma here and there's negative gamma here. And there is something which is called the gamma flip, when positive gamma turns into negative gamma. And again, this is how a market maker or dealer book looks like. So what are clients actually doing? They own shares. Money managers, big institutions, private individuals, they own shares. What can they do with them? They usually are happy if market goes up, and they have a price target to say market goes up by 5%. Great. And how can I generate some additional income? Oh, I sell a call option out of the money. I'll get a premium for that. If the market goes up 5% to my level, I make this anyway, and then I'm getting called away, but I've received an additional premium. If market goes up only slightly, I have the additional premium. What are they going to do with additional premium? They buy protection on the downside, and now you see where the negative side from the market maker books come from. I have to buy calls because that's what they're mostly doing all the time, and I have to sell put options. So my book is now gamma long in this perspective and gamma short on the left side. I'm short the puts, I'm long the gamma. I've netted my gamma position up. There is a flip here when we go from gamma long to gamma short. The max pain was calculated earlier at 470 and the market was trading at this point in time at 513. The gamma flips roughly around 500 here. So the dealer positioning is now, okay, if the hypothesis would work that the max pain rate is what we constructed earlier, then I would be short the puts, which is correct. That is happening in my book as well. But I would also be short the calls, because apparently under this thesis, Clients only buy options. They buy calls and they buy puts, and that's all they do. And we've just established, out of experience, from 1995 till now, that's what clients are doing most of the time, and it's not what they're doing here. Clients are not sitting there and buying calls all the time and buying puts all the time. If we would have a scenario like this, then there would also be the gammas, the distribution, which might make it even possible that this max pain trade might be the level where we eventually would come in. So the dealer position, the market maker position, would actually be a short strangle in this case. Yeah? I'm short the puts and I'm short the calls. I'm gamma short all the way. And when I'm gamma short all the way, I would have a lot of gammas here going down. I would have a lot of gammas here going down. So that would be beneficial for me where I have the least gamma exposure at this point. And then the market forces, because, and that's what I haven't mentioned yet, I have to hedge my position all the time. Yeah? If I'm positive gamma, then I'm providing liquidity to the market, because if markets go up and I'm long the calls, I get more long, and if markets work against me, I get less long. It doesn't mean I don't lose any money, but as my delta is hedged, it just means it's beneficial. The positive gamma allows me to simplified buy low and sell high. How can I do that? Market goes up and down, I have to hedge my delta position. This simply means if the market goes down, I can provide liquidity to the market. I buy the downside. If the market goes up and I'm positive on gammas, I can sell. I can provide liquidity to the market. What does that lead to? You've all seen it before. Market goes up, volatility comes down. Why does volatility come down? Because market makers and dealers can provide liquidity in this scenario if their books are structured like this, which they are most of the time. So that's my long call. That is responsible for reduced volatility in markets and the ability to, on a downtick, buy and on an uptick, sell. Short position, it's my short put. Yeah? I'm gamma short here as a market maker. What does that lead to? If we're going down fast. Why is that? Because I'm through a short put, I'm actually long. The market falls, I have to hedge myself. What I have to do? I have to sell. I have to sell underlying. When the market gets thinner and it's falling fast, I'm the one who has to start selling as well. Yeah? And then the market falls a bit sharper and I have to sell even more. In easy terms spoken, when I'm gamma short, which means I have to buy high and I have to sell low in my hedging. What does that mean? I'm taking liquidity from the market away. Just assume we're going into a downturn scenario, crash scenario. All customers in the world want to sell their equities. They don't like it. In my position, out of this book, I get longer and longer and longer. What do? I try to keep my delta neutral or even slightly delta short. I also have to sell. But in this case, there is no dealer or market maker who's providing additional buying power. Yeah? Now I'm on the other side. I have to sell as well, which means volatility will go up, markets will go down faster, and we have this scenario you're all very familiar with. Yeah? Markets go into correction territory. What does the VIX? Goes up. Single stocks start falling. Most of the time, volatility goes up, and the downturn is much faster than the upturn. Yeah? It's very slow to the upside, and it can be very, very fast if the market is choosing the downside we have in here. So what position do I have here? I have a long call. I have a short put. Yeah? If we forget that bit in the middle, that's pretty much the payout profile of just being long equity. I'm long delta in this trade. Yeah? As a market maker, I'm selling my deltas in the underlying when I have the option position, and the max pain from our earlier calculation is somewhere here in negative gamma territory already. But I've mentioned the flip earlier, which is here. Yeah? And that's the important part to look at. As long as I'm here in this part, I can provide liquidity. When the market goes down and I'm in that region, I take liquidity from the market away. Well, I had a beautiful slide earlier in here. Where is that? Let me get through again. Okay, we can do it in what actually really happened. Everybody likes that. So, when I did the presentation, published on the 6th of March, obviously I had data from the 5th of March 24, and the next expiration was where the red arrow is here. That was the cycle we were looking at. Yeah? S&P was trading at 513, and we did the calculation and said the max pain, if that would be true, would be at 470. At 470, most of all these options from here, way back, would expire worthless. And as market makers and dealers are evil manipulators, that's where they're going to push the price. So, we've already checked out earlier that we have positive gamma territory here, where market makers provide liquidity, and we have negative gamma here, where market makers and dealers take liquidity away. The flip was happening in our calculation around $500. Where did the market expire? At 510. Why was that obvious? You can see here this candle. Obviously somebody was trying to push the market down, but they were trying out to swim against the tide, because the market makers could say, oh great, market is falling, suddenly I can buy cheap delta, because my gamma makes me at that point short, so I hedge it. And if market goes up, I'm already long, and the higher the market works, the more I can sell on the top and the more I can buy at the low. And that exactly happened here. We didn't come 510. We didn't even get in the region of the flip level. If we would have crushed through the flip because of some external event, then the max pain could have been achieved. But the max pain is not trying to be aimed for the reason that most options expire worthless. The dynamics are happening on the gamma distribution we have, because market makers and dealers and large institutions have to hedge their positions. They do that through the delta, and if they have a positive gamma, repeating myself here, then they can spend liquidity in the market, and that's exactly what you've seen here. Market was trying to come down brutally, and nope, positive gamma, I can buy lows and I can sell highs. And then we have an expiration, and the market made another move we have here. So let me thank you for your attention. I hope you like this little, lecture explanation from a market maker who was in the field now for almost 30 years, and give you an idea when you listen to a lot of good YouTube videos where very convincing people are telling you why this is the point. It's not. It can coincide, and the distribution, the gamma distribution, can be in fact like a strangle, but that is not happening most of the time. Most of the time, you have the distribution here you've seen right now. Market makers are gamma long on the upside and gamma short on the downside, because they have to buy the calls and they have to sell the puts. What I always do at the end, some book recommendations. You have seen that probably in my other videos. If you really are looking for a good read for your holidays, don't start with Option Volatility and Pricing. It might be a bit dry, even though it's the best book for an aspiring young trader you could possibly get in your hands first. Read A Random Walk Down Wall Street if you haven't done so already, or The Misbehavior of Markets. And if you want to get more into the nitty-gritty bits, all these books are excellent. I read them. I know a couple of the guys who wrote them. Had drinkies with some of the guys on this list, and start looking into them if you really want to enjoy option trading and the appreciation of the risk and what markets can do. So where can you find us? We have a website. It's called thetacticalbrief.com. There will be articles I've published occasionally in for example, Macro Hive, and in publications for the professional market. We have videos on there, links. If you know our website, the Grey Market Talk, for example, is in English. It's my colleague Nick. He's also a retired market professional. He used to be Chief Investment Officer with almost $80 billion assets under management over all asset classes. And we explore the market. So you might want to enjoy that. And now I always give you the risk disclaimer. Obviously, none of this is investment advice. I'm not in the business of advising clients. I don't want to be in the business of advising clients. I'm in the business of putting out the odd little lecture and tell about my experience in the markets and how to understand complex topics. They're never really difficult. They're complex. If you get them explained the right way, leave a comment in the section below and tell me how I've done on this video. I hope I see you soon on this channel, and I'm already thinking about then I'm talking maybe about charm or delta decay, what it does to certain positions. Let me know if you would like to see that. Bye bye.